Have you ever opened up a stock screener and just felt completely lost? I mean, where do you even start? Well, in this explainer, we're going to build a really simple but powerful framework to help you find and evaluate great companies to invest in. Seriously, by the end of this, you'll have a clear, repeatable process you can use to cut through all that noise and make much smarter investment decisions.
I mean, look at this. This is the core problem for every single investor. There are over 43,000 publicly listed companies around the world. It's the classic paradox of choice. So many options that you just end up doing nothing. It can be totally paralyzing. But don't you worry, we are about to turn all that chaos into some serious clarity.
So, here's our game plan for today. We're going to use what's called a funnel approach. We'll start really wide and then get narrower and narrower. We're going to start with the right mindset, then we'll apply some simple number filters, check on the company's financial health, look at the stuff beyond the numbers, and finally, we'll put it all together in one super simple checklist. Let's do it.
Okay, so let's start at the very top of our funnel. Before we even think about filtering a single stock, we've got to decide on our core philosophy, right? Are we trying to pick individual winners, or are we just happy to ride the wave of the entire market?
You know, at the end of the day, there are really two main schools of thought here. You've got passive investors. They usually buy the whole market through things like index funds because they believe it's just too hard to beat the average. Then you have active investors. They believe that with the right research, you absolutely can find companies that will beat the market. Now, this explainer, this whole framework, it's for that active investor. It's for the person who wants to roll up their sleeves and do their own homework to find those exceptional businesses.
All right, now we get to what I honestly believe is the most important part of this entire process. Before you look at a single financial number, you have to adopt the right mindset. This is a philosophy that has been championed for decades by legendary investors like Warren Buffett.
And here it is. This is the whole game, right here. You are not gambling. You're not just betting on blinking lights and ticker symbols on a screen. When you buy a share of stock, you are buying a tiny piece of a real, living, breathing business. Every single decision you make from here on out has to flow from this one fundamental idea.
This analogy just illustrates the concept so perfectly. Think about it. If you were going to buy a farm, you wouldn't just look at what price someone was offering for it every day, would you? Of course not. You'd analyze its assets, you'd look at its earning potential, its costs. You would think like a business owner. We need to apply that exact same logic when we're buying stocks. Okay, with our business owner hat firmly on, let's get our hands dirty. It's time to dive into the first real layer of our filtering process. We're going to use a stock screener and some really simple numbers to dramatically shrink that universe of 43,000 companies down to a much more manageable list. We're going to use a simple but, trust me, incredibly powerful three-part screening process. We're looking for companies that are 1. Reasonably priced, 2. High quality, and 3. Not shrinking. Just doing this immediately filters out so much of the mediocre stuff and lets us focus our precious energy on the really good opportunities. So these are the specific metrics we're going to plug in. Now, don't let the alphabet soup scare you. For price, we'll use a ratio called EV to EBIT. Think of it like a better version of the PE ratio, because it also includes a company's debt. We're looking for a value under 15, just to make sure we're not overpaying. For quality, we want a return on assets, or ROA, over 10%. This just tells us how good a company is at using its stuff to make a profit. And for growth, it's super simple. We just want to see that their sales are going up, not down. This slide is just a brilliant way to understand why return on assets is so important. Imagine two restaurants. They both make $200,000 in profit. Awesome. But Bob's restaurant only needs $2 million worth of stuff, tables, ovens, you name it, to make that profit. That's a 10% return. Stefan's, on the other hand, needs $4 million in assets to make the exact same amount of money. So which business would you rather own? It's a no-brainer, right? Bob's is way more efficient. It's a higher quality business. All right, so our screener has done its job. We have a much shorter list. Now it's time to do a quick health check on these companies. We're going to pop the hood and look at their financial statements, just to make sure there are no big, scary red flags hiding in there. Every public company has to publish these 3 key documents that together tell its financial story. And listen, I know this can look intimidating, but don't worry. We only need to look for one key thing in each of these to get a fantastic snapshot of the company's overall health. First up, the balance sheet.
And the question we're asking is really simple. Can this company pay all of its bills for the next year? We find that out with something called the current ratio. If this number is above 1, it means for every dollar they owe in the short term, they have at least $1 in assets ready to cover it. It's a quick, effective safety check.
Next, we head over to the income statement. Here, we want to know, is the main part of the business actually making money? The operating margin tells us exactly that. It shows how much profit a company makes from its day-to-day operations for every single dollar of sales. A margin above, say, 15%, is a really good sign. It tells you the company probably has strong pricing power and runs a tight ship.
And finally, the cash flow statement. Look, at the end of the day, cash is king. Accounting profits can be, well, they can be played with. But actual cash in the bank, that's real. We want to see that the business is a cash-generating machine. We're looking for positive free cash flow. And ideally, we want to see that number growing over time. That is a sign of a truly strong and sustainable business. Okay, so we've narrowed our list, we've checked the financials, but now it's time for a really crucial pivot. Because the numbers on a spreadsheet, they don't tell the whole story. Not even close. The truly great, long-lasting businesses have powerful advantages that you just can't always measure with a number. And this quote from Buffett just captures that transition perfectly. Once you've found a business that's financially sound, you have to step back and ask yourself, do I get what this company actually does? Do I trust the people running the show? And does it have a real durable edge over its competition?
So here's what you're looking for. Does the company have a moat? You know, like a castle? Some kind of competitive advantage that keeps the competition out. Think about Coca-Cola's brand. It's a huge moat. And what about the management team? Are they experienced, dedicated, visionary? Think about a leader like Elon Musk. These are those intangible qualities that separate the good companies from the truly great long-term investments.
All right, let's move to the final step. Let's see how this whole thing builds into a single, actionable checklist. We're going to combine everything we've just learned into a repeatable process you can use for any stock you ever look at. And there you have it, your 5-step investing funnel. Step 1, start in your circle of competence with businesses you actually get. Step 2, run them through our 3-number filters. Step 3, do that quick health check on the financial statements. Step 4, analyze those qualitative factors, the moat, the management. And only then, after all that work is done, do you get to step 5, deciding what a fair price is to buy that piece of the business.
See, by following a framework like this, you're no longer just randomly picking stocks. You are methodically investing in businesses. You've moved from being a speculator to being a true business analyst. That overwhelming universe of thousands of stocks, it's now just a manageable field of opportunities waiting for you. So, my only question is, what business are you going to analyze first?